So you've done everything you were supposed to do, right? You're a doctor, a lawyer, an engineer, or some other kind of rock star professional in a high-paying career. You've climbed the corporate ladder or built a solid business and you're making great income. But there's this little voice in the back of your head, this feeling that despite your financial success, you're still just stuck on the treadmill trading your time for money. And you just know that real wealth isn't about earning more. It's about making your money work harder for you. You've probably heard that real estate is one of the best ways to build wealth, and you're not wrong. But then you start thinking about what that actually means. Becoming a landlord, screening tenants, dealing with evictions. Honestly, it sounds like a second full-time job that you just don't have the time for. So what happens? Your hard-earned money just sits in a savings account where inflation slowly nibbles away at it day after day. Or maybe it's in the stock market, which can feel like another roller coaster ride that you have zero control over. It feels like you're on the outside looking in, watching other people build real, lasting wealth with real estate while you're stuck on the sidelines. But what if I told you there's a way to own a piece of a large, professionally run apartment building? A way to collect passive income from hundreds of tenants without ever talking to a single one. What if you could use the skill of expert real estate teams to build a portfolio that makes you money while you sleep, travel, or just focus on a career that you actually love? This isn't just some fantasy. It's a strategy that smart investors use to build hassle-free wealth, and it's called multifamily syndication. Today, I'm going to break down exactly what it is and give you my top tips for getting it right. And at the end, I'll share a free resource that gives you everything you need to know to invest confidently in multifamily syndications. This is your masterclass on how to finally make your hard-earned money work just as hard as you do, without the hassle. But before we jump in, make sure to subscribe and hit that like button. All right. So what is multifamily syndication anyway? Let's make it simple. Multifamily syndication is basically a team sport. A group of experienced real estate pros called sponsors or general partners finds a great deal on an apartment complex, say a 150-unit building. They do all the heavy lifting, finding the property, negotiating the price, raising the capital, getting the loan, and creating a business plan to make it more valuable. But these are big multi-million-dollar properties, so they need cash for the down payment and the upgrades that they have planned. That's where you come in as a passive investor. You and a group of other people pool your money together to help fund the deal. In return, you essentially become a part owner of the building. In multifamily lingo, you're called a limited partner or an LP. Your job? Simple. You invest your money and share in the returns. That's it. You are 100% passive. The sponsor team takes care of everything. They manage the property, oversee the renovations, and handle all the day-to-day headaches. You get to share in the profits, which usually comes in one of two ways: regular cash flow checks from the rent money, and a big payout when the property is sold down the road for a profit. It's how busy professionals get all the perks of owning real estate, the cash flow, the appreciation, the awesome tax benefits, with none of the landlord nightmares. So now let's cover a few tips to help you lower your risk in these types of investments. Tip number 1, vet the sponsor, not the deal. If you only take away one thing from this video, remember this. In a syndication, you're not just investing in a building. You're investing in the team that runs it. The sponsor is everything. A great sponsor can take a good deal and make it a great one, but a bad sponsor can sink even the best opportunity. So how do you check them out? First, look at their track record. How many deals have they actually taken from start to finish? Anyone can buy a building, but you want a team that's taken them full cycle, meaning they bought the building, executed the business plan, and successfully sold it. Ask to see their past projects. What returns did they promise investors? And what returns did they actually deliver? Don't be shy about asking to talk to some of their current investors. Second, check for a well-rounded, experienced team. A good syndication company isn't just one person. They'll have experts in finance, property management, asset management, and construction. You want a team that knows how to handle the twists and turns of a large real estate project. And you want a team with experience in the specific market that property is in. Third, and this is huge, make sure they have skin in the game. This is all about alignment. The best sponsors invest a good chunk of their own money right alongside yours. It means their success is directly tied to your success. When you win, they win. And finally, check out how they communicate. A good sponsor will give you clear, regular updates on how the property is doing. They should be easy to get a hold of and happy to answer your questions before, during, and after you invest. You're getting into a long-term relationship here, usually 3 to 7 years, so you have to trust the people that you're in business with. Tip number 2, understand the deal and do your homework. Okay, so you've done your due diligence and you've found a sponsor you trust. Now it's time to look at the deal itself. The sponsor will give you a big packet of documents, and the most important one is called the Private Placement Memorandum. It's a legal document and it can be pretty dense, but you have to read it. Inside the PPM is all the material information about the investment, enabling investors to make an informed decision. Think of yourself as a detective here. What is the actual plan? Is it a value add project where they're going to renovate apartments and raise the rents? Or is it a more stable building in a really fantastic area? Then look at the market itself. Is the property in a city with strong job growth and more people moving in? A great market is like a strong tailwind for your investment, which is why sponsors love targeting these growth areas. And don't just blindly trust the sponsor's projections. Dig into their assumptions. Do their estimates for rent growth seem realistic for that neighborhood? Are their projected expenses in line with what's normal for the industry? A good sponsor will be conservative with their numbers, but it's your money that's on the line, and it's your responsibility to verify. You need to be comfortable with the game plan and make sure it fits your own financial goals. Tip number 3, know your numbers, both the returns and the fees. All right, now let's talk about the fun part, how you as an investor get paid and what it costs. In syndication, you'll see a few key numbers. First is the cash-on-cash return. This is just the amount of cash you get back each year divided by your initial investment. So say if you invested $50,000 and you get $4,000 back in the first year, your cash-on-cash return is 8%. Pretty simple. It's also a much better return than you're going to get in a CD or a savings account. Next up is the preferred return. This is a really great investor-friendly deal structure. For example, if a deal has a 7% preferred return, or PREF, it means that if there's cash to distribute, you as the LP are entitled to the first 7% of the profits before the sponsorship team gets their cut. It's a great way to make sure the sponsor is motivated to hit their targets. And finally, there's the equity split or profit sharing. After everyone gets their preferred return, any leftover cash and profits from the final sale are split between you, the passive investor, and the sponsor. The equity split varies depending on the deal, but a 70-30 split is pretty common, where 70% goes to the investors and 30% goes to the sponsor. Of course, you also have to understand the fees. There's a lot of heavy lifting that goes into these types of investments. Sponsors get paid for doing all this work, and that's all laid out in the PPM that I talked about earlier. You'll likely see an acquisition fee for finding the deal, an asset management fee for overseeing it, and a disposition fee when they sell it. These are totally standard, and the sponsor should get compensated for their efforts. But you need to know what they are so that you can get a clear picture of the deal's real potential. And you need to make sure that they're in line with industry norms. Tip number 4, the magic of diversification. My last tip is something that's true for any kind of investing. You don't want to put all your eggs in one basket. What's so cool about syndication is that it lets you spread your money out in ways you could never do on your own. Think about it. Instead of sinking $500,000 into a single-family rental house, you could put $50,000 into 10 different apartment syndications. This lets you diversify across different sponsors, different cities, and even different strategies and risk profiles. So if one property in one market has a slow year, it doesn't sink your entire portfolio. This massively lowers your risk. You could have an investment in a high-growth Sunbelt market and another in a super stable Midwest city. You could have one value-add project with huge upside potential, balanced out by newer, steady cash-flowing properties. Building a portfolio of different passive real estate deals like this is one of the most reliable ways to build serious long-term wealth. I know that was a lot of information to take in, but here's what it all boils down to. You don't have to be a real estate guru or sacrifice all your free time to build an amazing income-producing portfolio that builds serious wealth over time. The path has already been established for busy professionals just like you. I know because I've done it myself. To make it even easier for you, I've put together a free guide I call the Busy Professional's Guide to Hassle-Free Wealth. It gives you everything you need to invest confidently in multifamily syndications. The link is right there in the description below. Go ahead and click it and get your free copy. So let's wrap this up. You can get off that treadmill of trading your time for money. You can build real streams of passive income through real estate. And you can create hassle-free wealth. You can do all this with multifamily syndication. Remember, my top tips for your success are: 1, vet the sponsor like your money depends on it, because it does. You're investing in people first. 2, understand the deal and the market that it's in. Do your homework. And 3, know the numbers, both the returns and the fees. And 4, use the power of diversification to lower your risk and grow your portfolio. The opportunity to turn your high income into lasting wealth is right there in front of you. You just have to take that first step. Thanks so much for watching. If you got any value out of this video, do me a favor and like, subscribe, and hit that little notification bell so you don't miss my next video. I'd also love to hear your thoughts and answer any questions you might have, so make sure to leave them in the comments below. See you in the next one.